In the first place, in times of financial and economical uncertainty, gold steadily gains in esteem among the generality of mankind. In recent years, it has been an increasingly sought-for commodity. Until today, it can be said that it is the only commodity which is readily accepted in any quantity the world over. Wednesday, October 25th, 2023, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at money supply, or M2, and it's giving some very worrying signs in terms of deflation. And the last time we saw this happen back in 1933, there was a complete reset of the system in the United States. And by reset, I mean there was a devaluation of the dollar versus gold. Of course, gold is the ultimate monetary asset. It's not anything else. The dollar is not money. The dollar is credit. The fiat dollar, that is. Before we look at that, though, I just wanted to thank all of you again for your interest in the channel. And I want to reiterate, if you enjoy my videos and haven't subscribed yet, make sure you do. And if you're still sitting on the fence, keep following me and then decide whether you want to subscribe. And make sure as well you hit the little notification bell to be notified of all my new videos. And if you want to help the channel as well, there are details of how you can do that in the description of all my videos. So, I saw this tweet in the last 24 hours, and it's from Lawrence Lepard, and he retweeted a guy called Joe Consorti, and he came up with this chart here. M2 fell 3.6% in September, longest, deepest streak of money supply contraction since 1933. So what happened in 1933? What kind of reset was there? Well, if you have followed my channel, you know that when FDR was inaugurated in March of 1933, he declared a 4-day bank holiday. And why did he do that? Well, because there was a banking crisis in the U.S. Depositors, people were rushing to their banks to take their money out. And don't forget, back then, money was gold. Dollar bills and gold coins were interchangeable. And why was this happening? Well, because in the previous decade, in the 20s and early 30s, especially in the 20s, banks had issued too many loans that weren't backed by the commensurate amount of gold. So they were highly leveraged, and there was, of course, the collapse of Credit Anstalt Bank in Austria in 1931 that basically started the dominoes dropping, and it came to the U.S. because a lot of U.S. banks lent to German banks lent to Austrian banks, and it was a big mess. Britain also and some other countries left the gold standard. So yes, and Roosevelt also banned the ownership of gold in 1933 with the Executive Order 6102. So people had to hand in their gold. It was illegal to use gold as currency or money. And it stayed like that until January 1st, 1975. And then the reset happened in January of 1934 with the Gold Reserve Act. Because when Roosevelt banned ownership of gold, when he had the bank holiday, 1 ounce of gold was worth $20.67. And then in January, with all the gold that the Treasury had taken from the American people through Executive Order 6102 via the Fed, he revalued the value of gold to $35 per troy ounce. So that was the reset, and it helped him set up his New Deal, and it helped him increase government spending, and that was the Great Reset then. And today, though, how come we're not in a Great Depression in terms of prices? Why are prices out there not going down? I would tend to argue it's because government now, without a gold standard, has the wherewithal to deficit spend. We've seen recently that the deficit was 1.7 trillion for the latest fiscal period. So that's why we're not seeing the economy collapse, because the government is intervening. Back then, the government couldn't do that unless they did the reset. But I would argue that there will be a reset this time, but it won't be like official. It will be via the markets. And what do I mean by that? Well, I'm going to reference this book here, which I've had for a while, and it's a series of articles from the 1930s, especially I think around 1933, in the Times of London, and it's just entitled Gold. And I was reading about monetary gold stocks a few days ago, and I think this has everything to do with what's going on with the money supply, with gold, and how gold will actually, gold going up will mean a massive deflation. And bear with me, because we're going to go through this article here by Sir Henry Strakosch, or Strakosch, I'm not sure how you pronounce it. Who was Sir Henry Strakosch? Well, it says here he was an Austrian-born British banker businessman. And yes, he was a very influential banker in the, was born in 1871, died in 1943. It says as well, he was a Jewish financier. His close ties to Winston Churchill were exploited by Nazi propaganda during the 1930s and World War II. So there you go. Let's see what he said about monetary gold stocks, because we're seeing today countries like Russia and China and others, particularly in the global south, accumulate a lot of gold. And they accumulated a lot of gold last year, record amounts for about 80 years, and they're continuing to do so this year. So it says here, it is now widely recognized that the shifts and changes in the world's monetary stocks of gold in recent years have had a profound influence on the economic and through them on the social and political developments of the period. So this is how he starts. But he notes here that in 1931 and 32, monetary gold stocks went up substantially, but also in 1933. So I'm going to skip here to the part of the article where he talks about why the gold stocks increased so much. And there were a couple of countries back then, particularly the United States and France and even Switzerland, where the gold stocks went through the roof. And that was considered hoarding, because the gold wasn't being used for credit creation. And that's why they had problems with falling prices, or the consequence of deflation. Back then, deflation was gold hoarding, and I would argue that is going to be the same in our time, even though a lot of people don't consider gold money. But he says here, finally, an interesting point which should be noted in this hoarding of gold in England in 1933, which probably represents gold held for foreign account and indicators in large part the nervousness of the owners of such gold as to the future maintenance of the gold standard in the countries which still remain on it. The foregoing review of the statistics of monetary gold brings out the following important facts. First, the production of new gold in recent years has been sufficient to supply the world's requirements, which are normally continually increasing as a result of economic progress, and therefore to support a stable level of prices if other conditions had been normal. Secondly, the increase in the world's stock of monetary gold has been at an even higher rate, largely due to the release of hoarded gold from Eastern countries. Well, that was from India and China. Thirdly, in spite of the increased supply of metal available for monetary purposes, the stock of a large proportion of the countries of the world have been severely depleted by withdrawals of the few remaining countries, with the result that far from being stable as the supply of gold justified, the level of prices has fallen precipitously. And lastly, the increase in the purchasing power of gold, which this fall in prices implies, has been accompanied by steadily increasing hoarding of gold by Western countries. So back then it was Western countries that were hoarding gold. Now it's not Western countries that are hoarding gold, which in recent times has developed almost into a scramble for gold, and by a consequent acceleration in the rise of its purchasing power. So there you go for those people who think that deflation is going to hurt gold. No, gold, a scramble for gold or a rising purchasing power of gold is the other side of deflation. From these facts, we can draw two useful conclusions. In the first place, in times of financial and economical uncertainty, gold steadily gains in esteem among the generality of mankind. In recent years, it has been an increasingly sought-for commodity. Until today, it can be said that it is the only commodity which is readily accepted in any quantity the world over. In the second place, the review clearly indicates that there was something radically wrong with the working of the old gold standard. In spite of an adequate, indeed an abundant supply of monetary gold, which should have been sufficient to keep its value stable, the standard broke down mainly through the rapid increase in the purchasing power of the metal. That increase was no doubt largely brought about by the misuse to which gold was put by a few creditor countries. I think here he means the United States and France. France increased its gold holdings massively. Let's see here. I can give you the numbers. 1928 had 256 million pounds of gold, and by March 1933 it had 646 million. The US in 1928 had 770 million. By March 1933 had 804 million. So there's a lot of hoarding there. So let's continue. Instead of its use being limited to its legitimate function of serving as a basis of credit and as a medium of international payment, gold was made to serve in an increasing measure as a store of wealth. So I'm going to stop here. I think you can get this book. It's quite easy. It's called Gold by the Times of London, and I think it was published in 1933. Is easy to get. I looked at it the other day. I don't remember when I bought this and from where, but I'm starting to read it a bit more, and I thought that was interesting. And he says that the gold standard was misused by creditors, and maybe to some extent it was, but the reason why I think it was misused is because creditors didn't trust the system. The system was too leveraged from the 1920s. And there were a lot of banking failures. So is it any wonder that that was a scramble for gold? And this was in the biggest deflationary period that there was, the 1930s. And looking at that chart that Joe Consorti just published, made me think about the 1930s and that we're kind of entering a kind of period that will be very deflationary, and we're already experiencing it in terms of real money, i.e. gold, and I think it's going to get worse. And it's going to be different than the 30s because back then, money was still relatively sound. The credit boom wasn't as big as it's been this time around. So what I'm trying to say is, in fiat currency, things are going to feel really bad. It's going to feel like we have inflation, i.e. we're going to have rising prices. And that's why I keep saying that gold will protect you, and silver as well. I think silver is going to follow suit, but gold is more important, I think, because the big investors, they're going to scramble for gold just like they did in the 1930s. And don't forget, yes, they scrambled for dollars, but up until 1933, well, the dollar was gold, right? Even for domestic use. And the U.S. did stay under the gold standard, though, up until 1971. So there you go. That's the conclusion that I see here. We can continue to see this money supply shrink, which is a bad thing for the economy. How do I think they're going to make up for it? Well, unfortunately, through military spending. And I see headlines here that are not very comforting. I see that U.S. moves to deter Iran ahead of Israel's invasion of Gaza. Am I saying the U.S. shouldn't deter Iran? Or no, I'm just observing things. And it looks like this conflict could get much bigger. And military spending, the military spending or defense spending we've seen via the Ukraine war could get even bigger. And if the U.S. gets involved in some kind of activity in the Middle East, I think it could trigger a much bigger conflict. So these are really uncertain times, and it's going to make I think the scramble for real money even more desperate, and there will come a time when you won't be able to really exchange any fiat currency for real money. And that's why I think if you can still do it now, it's you're lucky, I would say. So with that, let's quickly check where the markets are this morning. And before we look at the markets, just wanted to say that I interviewed Lynette Zhang yesterday, and I posted it overnight. So I'm going to put it up here in the cards if you haven't seen the interview on YouTube, so you can watch that later. So right now it's almost 9 a.m. London time. We've got gold, the spot price, and the spot price means the price for immediate, 1 or 2 day delivery. Is not the futures price. I know that the banks, the bullion banks that trade in the spot market, a lot of it is just paper, but there is allocated trading. And I know it doesn't reflect the real cost of physical gold, but it's the price that's used out there. But right now we're at 1971. We're pretty much unchanged. The range has been relatively narrow overnight, 68 the low, 77 the high. Silver is trading at 22.85, it's down 5 cents. High's been 23.03, the low's been 22.80. Dow futures down 11, NASDAQ is down 112, S&P is down 20. Currencies, the pound is down 0.2% at 121.38. The euro is unchanged, 105.85. The dollar is still around 150. It hasn't traded above 150 versus the yen. I think the BOJ is capping that level. We're at 149.90. And I will note that the dollar did rally yesterday. The fiat dollar did rally against fiat currencies. And we do cover these currencies, of course, every day. But I would say that the ultimate money that you need like Sir Henry Strakosch said, is gold. It's accepted everywhere around the world, especially in these turbulent times. So what about the yuan? Well, the yuan is pretty steady, or the dollar is up slightly at 732. Let's look at the other currencies. Aussie dollar is unchanged, 63.55. The dollar is up slightly versus the Canadian dollar at 137.62. And the Kiwi dollar is unchanged at 58.40. To the commodities, WTI crude is down 0.5%, 83.20. Brent is down 0.5% as well at 87.02. Platinum is down $6, trading at 885, and high-grade copper is down slightly at 364. So let's check the bond yields. The 10-year Treasury yield is up 1 basis point at 4.85. The UK 30-year yield, which is one that I think we should keep an eye on at the moment, is up 4 basis points at 5.05. The 2 years at 4.82. So with that, I'm going to wish you all a very good day. Take care. Bye.